made an investment that you thought deep down was a bad idea, but you just did it anyway? Yeah, same here. I've made some truly painful mistakes as an investor, and one of them wiped out half my investment in about 6 months. So in this video, I'll break down the 3 dumbest investment fails that I've made so that you can hopefully learn from them and not repeat the same dumb mistakes. Let's kick things off with the first dumbest thing that I ever did as an investor, which was chasing hype. Now, if you've ever scrolled through X or Reddit and thought, wow, everyone's getting rich off of this meme coin, you are not alone. I've been there. And let me tell you, it didn't end well. So here's what happened. So back when Dogecoin was all over the news, I got, caught up in the excitement. And what happened next was honestly one of the more embarrassing moments in my investing journey. Truth is, Dogecoin started as a joke, literally, but then it exploded in popularity, especially after big names like Elon Musk started to tweet about it. At one point, Dogecoin's market cap hit billions of dollars, and it felt like everyone was making easy money.
Just to put numbers to that, Dogecoin's market cap peaked at around $88 billion in May 2021. That's more than the GDP of some small countries, for a joke coin with no inherent utility.
Yeah, it's truly insane, Tiara. Now, I bought in when Dogecoin was already losing steam around June, July of 2021 at about 20 cents. And spoiler alert, it didn't bounce back to its all-time highs of 64 cents like I had hoped. Now, I ended up selling it roughly 6 months later, losing half of what I had invested. And honestly, I learned a tough lesson about greed. And just so that we're clear, that's the embarrassing moment that I hinted at a moment ago here.
That's what you get.
Now, the lesson was learned the hard way, right? Don't mistake social media buzz for solid investment advice. The thing is, meme coins like Dogecoin, they're super volatile. One day you're up, the next day you're staring at your account, wondering where your money went. So as of late May 2025, Dogecoin is trading around 22 cents, but it's been all over the place, which isn't too surprising for a meme coin. So why do so many people, including myself, make dumb investments like this? Well, it's called FOMO, fear of missing out. According to a Kraken survey, 84% of crypto investors admitted making decisions based on FOMO, and 63% lost money as a result. The hype is powerful. You see the headlines about the coins going to the moon, and you think you're missing out on the next big thing. But these coins are often driven by social media buzz, not real value. When the hype fades, so does the price and your investment, obviously. Now, if anything, investing in meme coins with practically no utility is nothing more than gambling. And when it comes to investing, that's just not a good strategy. But that wasn't the only time that I let emotions steer the wheel. In fact, my first investing mistake happened way earlier, and it involved a lot less hype, but just as much regret. All right, so let's move on to the second dumbest thing that I ever did as an investor, which is buying penny stocks with literally no idea whatsoever what I was doing. And this one involved money that I didn't technically even earn myself. Yikes. So this one takes me way back to when I was 16 years old and I just started to dip my toes into the world of investing. And if you're thinking I'm too young at that point to invest at 16 years old, you're right. So since I was born, my dad had money saved up in an investment account on E-Trade for me. It wasn't a ton, but I thought I was the next Warren Buffett. And spoiler alert, I was not. To be honest, the memory itself is a bit hazy, but I remember that I found some random chemical company stock. And honestly, I couldn't even tell you what the company did or anything. And I just saw that the stock was super cheap. And I figured, hey, if it goes up even a little, I'll make a ton of money. Well, the only thing that went up was my stress level. I ended up losing about $900 in the account with a total balance of around $8,000. And that stung. And I still remember that sinking feeling in my stomach and thinking that my dad was going to kill me when he found out. But interestingly, when my dad found out, he just shrugged and said, well,
I want to kill this kid.
It's supposed to be your money anyway. So he figured that I learned a lesson, and he was right. I never, ever invested in a random stock that I knew nothing about again. So that moment stuck with me, not just because I lost money, but because I realized just how little I understood about investing. And here's the thing that everyone should know about penny stocks is that they're incredibly risky. So according to a study by the Financial Industry Regulatory Authority, or FINRA, 90% of penny stocks fail or lose significant value, and only 1 in 10 ever see any real gains. The reason? Well, these stocks are often targets of scams and manipulation. Now, if you think losing money on a 50-cent stock stings, wait until you try to outsmart the entire market like I did. The next mistake here didn't just hurt, it actually wiped out way more than a few $100. So now let's dive into the third and honestly the most expensive mistake that I've made multiple times as an investor, which is trying to time the market. If you've ever panicked during a big market drop and thought, well, maybe I should just sell everything before it gets worse, you're not alone. I've been there myself more times than I'd like to admit, and every single time, except recently, it has cost me. So let me paint the picture here. So the first time I really got burned by this was in the 2008 financial crisis. The market was tanking, obviously, and everywhere you look, people were freaking out. I let fear take over and I sold off everything, thinking I could just go buy back in when things calmed down. But what really happened? Well,
we all know what happened later.
the market bounced back faster than I expected before I invested anything, and I missed out on a huge chunk of the recovery. Now, I've repeated this mistake at least 5 times in my life. In fact, I most recently sold stocks during the trade war headlines and all the tariff drama with Trump as president here. The only difference is this time I didn't sell anything in the funds, and I only sold individual stocks that I felt weren't going to be able to deal with the new tariff policies. So at least I wasn't as dumb as I have been in the past. And frankly, it worked out for me pretty well so far. But here's why timing the market is so tough. Nobody can predict exactly when the market will go up or down, not even the pros. According to a study by JP Morgan, if you miss just the 10 best days in the stock market over the last 20 years, your overall returns would be cut in half. That's right, just 10 days out of 20 years can make all the difference. And guess what? Those best days usually happen right after the worst days, when people are way too scared to invest.
Exactly, Ron. In fact, 6 of the 10 best days in the market over the past 2 decades happened within 2 weeks of the 10 worst days.
And that's the problem with trying to time these things, right? So let's look at a hypothetical example here to kind of put some things in perspective. So imagine you have $10,000 invested in the S&P 500 at the start of 2004. If you just left it alone for 20 years, by 2024, you'd have $64,844. But if you missed the 10 best days because you pulled money out during the dips, your balance would drop to around $29,708, which is a $35,000 difference because you tried to outsmart the market and you missed just a few good days. Why is it so hard to avoid this? Well, it's because our brains are wired to hate losing money. Behavioral economists call this loss aversion, which is the pain of losing. It really feels way worse than the pleasure of gaining.
Of course, there are times when selling makes sense, like when your portfolio is wildly unbalanced or you've got better opportunities elsewhere.
Yes, this is absolutely true. So for instance, earlier this year, I had to sell a bunch of NVIDIA stock to rebalance my portfolio because I was gaining and losing tens of thousands of dollars per day, which was just too much emotionally for me to handle. While I do think it's okay to look at your holdings and rebalance or reallocate holdings based on the current market conditions, like I did with tariffs, you really should hold more funds than anything, and those should never be sold off unless you're in retirement or really need the money for something. So now that you've seen how human emotions and bad timing can sabotage your investments, let's flip the script here. So in this video right over here, I handed $5,000 to an AI to see if it could make smarter investing moves than I have. And the results have been surprisingly eye-opening. So go ahead and check it out, and I'll see you over there.